Hello and welcome to our video about the secret investments that the wealthy typically avoid. Are you sick of wondering how the wealthy become wealthier? Have you ever found yourself puzzled why certain seemingly safe investments don't seem to work out for you? Now you can stop wondering. In this video, we will expose 7 investments that the wealthy frequently avoid and discuss why. Mastering these tactics will teach you how to invest like the wealthy and maybe build your fortune over the years. This video is for you regardless of whether you're just beginning to invest or have been doing it for a long time. So sit back, relax, and join us as we investigate the wise investing decisions that might lead you to success in life. If you find this topic interesting, please remember to like it and to subscribe to our channel. By doing so, you'll be among the first to learn about new videos aimed to assist you on your financial path. Let's start with timeshares. Timeshare is a type of property ownership arrangement in which numerous people or organizations share ownership of a vacation home, such as a condominium, for a predetermined length of time each year. It's primarily offered through giving presentations and pitches, which are frequently held in holiday locations or resorts. The owner of a timeshare is liable for both the initial cost of purchase and the annual maintenance payments, which can be expensive. In exchange for this payment, the owner usually gets the privilege of using the land for a specific length of time each year, usually a week or two. Although it may appear to be a good deal, the rich prefer to avoid them for a few reasons. First of all, timeshares sometimes have hidden fees and limitations that reduce the value of the investment. Timeshare owners, for example, may be obliged to pay yearly maintenance costs or face blackout days in which they cannot use their timeshare. Besides that, the property's value might not always increase significantly as much as other types of real estate investments. The value often stays relatively constant or even drops over time. As a result, investors could even struggle to achieve a large return on their financial investments. Investors may want to look at several alternatives to timeshares. One of the options is purchasing a vacation home entirely. This allows investors to have more authority over the land and produce rental money even when not in use. Another course of action is to rent vacation residences on a short-term basis through vacation rental businesses such as Airbnb or VRBO. This enables them to enjoy a wide range of holiday properties even without long-term commitment or financial strain that comes with owning a timeshare or vacation property altogether. Lastly, investors may want to explore investing in a vacation real estate investment trust. REITs enable investors to own a portion of real estate holdings, which may include vacation homes, without having to manage the assets themselves. This is a more stable and diverse approach to invest in holiday properties with a possibility for higher profits. Second investment that the wealthy avoid is penny stocks. These are equities that trade for less than $5 per share and are frequently transacted on over-the-counter markets or smaller exchanges. Because of their low trading volume and lack of liquidity, in addition to the fact that the firms issuing them are sometimes relatively unknown or have limited operational history, these stocks are regarded as extremely speculative and dangerous. Penny stocks are extremely speculative, therefore they have the potential for huge gains, but they also have considerable dangers. Companies that issue penny stocks are frequently in the early phases of growth and may lack a track history of profitability or success. This could present challenges for investors to assess the investment's long-term prospects. While they have the possibility of producing significant returns, they are not ideal for most investors, especially for people who are risk-averse or prefer more predictable and secure investments. Investors should consider making investments in mutual funds or exchange-traded funds that specialize on small-cap or mid-cap firms' cheaper options to penny stocks. These funds often invest in equities of firms with market capitalizations ranging from $500 million to $10 billion, which might provide better potential returns than bigger, more successful organizations while avoiding the severe risk associated with penny stocks. Another possibility is to invest in blue-chip or large-cap stocks, which are often provided by well-established, financially stable corporations with a lengthy track history of revenue growth and achievement. While these equities may have lesser expected gains than smaller, riskier investments, they are typically thought to be more stable and risk-free. Assets and other fixed income methods which provide a consistent source of income and are less risky than stocks may also be considered by investors. These investments may be especially appealing to risk-averse investors seeking more steady and predictable assets. Third is annuities. Annuities are fundamentally contracts between a person and an insurance company in which the parties have agreed to make a payment in one lump sum or a regular installment in compensation for a stream of steady income distributions over a certain period of time. While annuities can provide a regular source of income in retirement, rich individuals may choose other options for their investing requirements for a variety of reasons. For starters, annuities can be costly. Annuity fees can be substantial, with insurance firms charging for administration, investment management, and other expenditures. These costs can eat into an investor's profits, lowering the investment's total worth. Moreover, annuities can be rigid. After purchasing an annuity, an investor often has limited power to amend or remove their investment. If an investor's financial circumstances or investing intentions change over time, this lack of flexibility might be troublesome. Lastly, annuities may fall behind inflation. Annuities' income payouts are usually fixed, which means they do not fluctuate for inflation over time. This can reduce an investor's spending ability over time, potentially resulting in a poorer quality of living in retirement. Investing in a diverse portfolio of assets which can generate a consistent income source over time can be a substitute for annuities. This strategy entails assembling a portfolio of investments such as dividend-paying equities, real estate, and bond funds that can provide a consistent cash flow while also presenting the possibility of long-term capital growth. It is feasible to establish a diversified portfolio that could really give protection against market volatility and offer a steady income stream in retirement by investing in a mix of assets customized to an investor's personal goals and risk tolerance. Additionally, working with a financial advisor to select assets that meet an investor's objectives as well as risk tolerance while offering a consistent stream of income over time is the key to finding an alternative to annuities. Investors may create a personalized retirement plan that will help them reach their long-term financial objectives by researching various investment possibilities and working with a trustworthy advisor. Let's now move on to the fourth topic: multi-level marketing. It's a business strategy that entails recruiting a chain of persons to promote goods or services, and participants are reimbursed not just for their own sales, but for the additional sales of the people they recruit. While multi-level marketing can be a successful business option for some, many wealthy people reject it for a variety of reasons. To begin, building a strong network in MLM sometimes necessitates a large commitment of time and effort. Rich individuals may be unwilling to commit the time and energy required to recruit and train a big sales crew. They may opt to concentrate their efforts on current company endeavors or investments that provide a better return on investment with less personal engagement. Next, MLM frequently includes the sale of low-cost items or services with minimal profit margins. This implies that in order to earn a substantial revenue, members must make a big number of sales, which can be time-consuming and difficult. Rich people may want to focus on higher-ticket things that have a bigger profit potential and require fewer sales to meet their financial objectives. Moreover, rich people may have access to other investment possibilities that provide a better rate of return while imposing less risk. MLM may be a dangerous endeavor because the success of the business is dependent on the abilities of the members as well as the company's viability. Rich people may opt for investments in more established firms or sectors that provide more stability and security. Imagine yourself as a young entrepreneur, keen to explore new revenue streams. You've heard of multi-level marketing, but something about it does not really feel quite right. Perhaps it's the stigma attached with pyramid schemes, or the pressure to build a sales network. Whatever it may be, you should be looking for an option that is more in line with your beliefs and aspirations. Fortunately, there are plenty of additional solutions to explore. Affiliate marketing may be just up your alley if you're technologically adept. you can advertise items or services in which you have a genuine interest and earn a commission on each transaction. E-commerce may be more your pace if you're the creative type. You may create your own online store and sell one-of-a-kind things that reflect your character and flair. If not, and if you're a qualified expert, freelancing might be an excellent choice. You may utilize your skills to help others while still earning a living. Nevertheless, if you're truly ambitious, creating your own business can be the best option. It may be difficult, but the potential benefits are immense. It all comes down to picking the solution that best fits your interests and talents. Thus, get innovative, utilize your imagination, and find the ideal golden chance for you. Fifth investment that the wealthy avoid is commodities. Let me take you on a speculative journey into the reasons why they shun it. Imagine yourself as a wealthy investor, sitting in your luxury office, deliberating over the greatest investment prospects available. You've heard about the commodities potential, but you're cautious to go in. Why, you might ask? For instance, commodities are quite volatile. They are affected by market movements, weather, and geopolitical events. As a result, they are unexpected and difficult to foresee. Besides that, investing in commodities necessitates a high level of skill. You must understand supply and demand patterns, transportation logistics, and storage costs. This kind of skill takes time to develop, and even with that, success is not guaranteed. As such, commodities are frequently vulnerable to government laws as well as geopolitical threats. Changes in government policy, trade conflicts, and natural catastrophes may all have an influence on commodity supply and demand, causing price volatility. If you're thinking about investing in commodities, you should explore other investment opportunities that may provide better security and predictability. First is ETFs. Like stocks, ETFs are sort of an investment vehicle that operates on an exchange. They're intended to monitor the growth of a certain index or sector and can provide diversification as well as minimal costs. ETFs allow you to invest in a variety of assets, such as stocks, bonds, and commodities, without having to purchase individual stocks. Another investment option is real estate. It is a tangibly valuable asset that may be used for a multitude of reasons. It provides a consistent stream of revenue in the form of rental payments, making it a dependable source of cash flow. It also tends to be less volatile than commodities. While the real estate market has ups and downs, it is less prone to the dramatic swings and precipitous declines seen in commodities markets. It also appears to be less vulnerable to unexpected geopolitical developments, which can have an influence on commodities prices. With a correct investing strategy in place, you could exceed your financial goals over time while limiting risks and avoiding commodity volatility. So why not look at your options and pick the best investing path for you? Second to the last investments that the wealthy avoid is high-yield bonds. Why? First and foremost, high-yield bonds are dangerous. These bonds are typically issued by hazardous enterprises, either because of their bad financial condition or maybe because they operate in a volatile industry. As a result, high-yield bonds have a greater default probability than investment-grade bonds, putting your money at risk. Furthermore, high-yield bonds are frequently exposed to interest rate risk. This implies that if interest rates go up, the value of these bonds may fall precipitously. High-yield bonds are more exposed to interest rate changes since they generally offer larger returns to compensate for their increased risk. High-yield bonds are additionally potentially unstable. This makes them difficult to sell, especially during periods of market turmoil. If you need to sell your high-yield bonds immediately, you may discover that there are no buyers available, resulting in large losses. You may continue to develop your wealth over time while limiting risks and avoiding the problems associated with high-yield bonds if you invest prudently and methodically. When it involves investing, there are several choices that provide excellent returns while avoiding the significant dangers associated with high-yield bonds. The first option is dividend-paying stocks, which are shares of established firms that distribute a portion of their earnings to owners on a regular basis as dividend payments. These companies have the potential for substantial returns since dividend payments can provide investors with a consistent source of income. Additionally, dividend-paying equities are often issued by corporations with good financial standing, which offers investors a measure of stability. Investors can profit from the potential for significant returns while reducing their overall risk by investing in dividend-paying equities. The second choice is peer-to-peer lending. It's a type of lending which individuals lend funds to those in need without the use of typical financial institution. This investment management method gives investors the opportunity to make substantial returns by receiving interests on the loans they supply. Also, investors may carefully pick borrowers to reduce risk exposure and diversify their assets across many loans. Peer-to-peer lending can be an appealing investment option for people seeking high returns outside of standard investment vehicles, but it is critical to thoroughly investigate potential borrowers and diversify your assets to avoid risks. Lastly, and the seventh investment that the wealthy avoids, is single stocks. Individual stocks or shares of a certain firm that are openly traded on a stock market are referred to as single stocks. When an investor purchases a single stock, they are purchasing a piece of an organization and are eligible for a fraction of its earnings in the form of dividends, as well as the possibility for capital appreciation if the price of the stock increases. Yet, investing in a single stock carries substantial risk because the stock's value can be influenced by a range of variables such as economic uncertainty, business performance, and additional economic conditions. While investing in single equities may be appealing to some, the affluent recognize the significance of investing with caution and diversification. They may develop long-term wealth while limiting risks and maximizing profits by avoiding single stocks. Investing in single stocks might be dangerous, but fortunately, there are many alternative investing choices available that can provide significant returns while limiting risk. First is index funds. Investing in index funds is a sensible method to acquire stock market exposure while avoiding risks. Index funds, as opposed to actively managed funds, are managed by a professional fund manager, track the performance of a certain market index. It allows you to take advantage of the stock market's potential for significant returns while simultaneously benefiting from more diversity and cheaper expenses than investing in individual equities. It is also seen as a low-maintenance investment option, making them an excellent alternative for individuals seeking to expand their wealth without devoting a significant amount of time to monitoring their assets. Another option is alternative investments. Private equity, hedge funds, and venture capital funds have the potential for big profits. Investors can gain access to markets that are generally inaccessible to ordinary investors by investing in non-traditional assets, thereby reaping bigger benefits. Alternative investments can also provide investors with the benefit of low correlation with traditional asset classes, which can aid in portfolio diversification and risk reduction. To summarize, investing may be complicated and involves careful evaluation of one's financial goals and risk tolerance, but nonetheless, by learning about investing tactics that the wealthy frequently reject, you may diversify your investment portfolio and boost your chances of financial success. And that's a wrap on our video about the investments that the wealthy typically avoid. We hope you found our content useful and informative. Remember that investing is not a one-size-fits-all proposition, so do your homework and seek expert guidance before making any financial decisions. Do not forget to like and subscribe to our channel for more useful information and to click the notification bell to be notified when we add new videos. We thank you for sticking around and we will see you in the next one.